Welcome to Beavers Wealth Management's March 2025 edition of Let's Talk Markets. As always, our goal is to educate and empower the families and businesses we serve. So if you know of anyone who might find today's conversation valuable, please share this with them. We're here to help. As we wrap up the first quarter of 2025, it's clear that the markets have given us plenty to talk about. And to put it plainly, it's been a volatile last couple of weeks. Headlines are shifting daily. Investors are feeling uneasy. And everyone is asking the same questions. What's causing all this? And where do we go from here? So today, we're going to take a step back. We got to cut through the noise, and we got to provide clear answers about what's happening in the markets and what's driving our caution, but just as importantly, why we're still optimistic moving forward. Now, we truly appreciate you joining us, and let's dive in and let's take a good, hard look at where markets actually stand today, halfway through March. So as we typically do, market synopsis of what have the typical indices done during these last couple of months? Well, just this last month, you saw the S&P 500 continue to extend that decrease into 2025. Last week was down about 2.2%, and for the year, down about 4% is what we saw in the S&P 500. Now, that's very different than what we're seeing in the NASDAQ, which has been, over the course of the last couple of years, the best performing index across the board. This year, down about 8%. Looking across the board, all indices are negative for 2025, except a few of them, most of which have been in the almost double-digit decline. But there are some sectors that are actually positive this year. If you look at energy, utilities, healthcare, all of these sectors positive for the markets. The worst three performing sectors, because I know we usually like to talk about them, which had been the best three over the course of the last couple of years: consumer discretionary, information technology, and communication services. So that gives you a little bit of an idea of kind of where we've been over the course of the last couple of months. Now, as we typically do, I want to go through today's market fact, Ryan's market fact, and what he titled this one is called The Price of Admission. It's one of my favorites that he's put together. And so this really helps from a perspective when you look at it. This is the 30th correction of greater than 5% off a high since the March 2009 low. The 30th correction over 5%. And let's be honest, they all seemed like the end of the world at the time. But looking at the chart, let's remember the two significant pullbacks we experienced last year. It's easy to look back and only remember the double-digit growth we saw for the entire year. But as investors, it's important to not overlook the pullbacks as well. The S&P 500 has returned an average of 10% per year since 1928, despite an average intra-year drawdown, are you ready for this, of negative 16%. So over time, it's averaged 10%, even though at any point during the year, on average, we've seen a 16% decline. There's a lesson here, right? There's no upside without occasional downside. No reward without risk. This is the price of admission. I thought it was a really good market fact from Ryan this month, especially with the volatility that we've seen. And so we're going to jump into that volatility, talk a little bit more about it. And I really want to kind of divide this into what we know and what we don't know to describe the volatility for 2025. Now, I first want to say that we don't believe the markets are down because of tariffs. I know that's what's on the news right now and what many people think are driving the markets, or any of the White House actions that we've seen. We actually believe that markets have declined primarily because they were fundamentally overvalued, which we've talked about in previous Let's Talk Markets. They've been driven by an extended period of artificially easy monetary policy and the ongoing kind of recalibration to realistic valuations explains the current volatility that we're seeing. But let's face it, Markets have been a roller coaster ride so far in 2025. We started off strong in January. Everybody was feeling great. February brought some unexpected bumps, which we've been going through over the course of the last 6 weeks. And it's reminded us that markets rarely move in a straight line, even though it seemed like that over the last couple of years, straight up. But if you're feeling a bit uneasy right now, you're certainly not alone. So today, what we're going to do is we're going to be honest and clear about what is driving this volatility, what we genuinely don't know, and there's plenty of that, and more importantly, what we do know. Our market outlook, as I said, is cautiously optimistic. We're cautious due to the uncertainties ahead. But we're optimistic because of the fundamentals that we can rely on. And so let's first start off about what we don't know. And I've broken this into 4 points here that I want to talk about. What's creating the caution here? Number 1, inflation's future path. We don't know exactly where inflation is headed next. Nobody does. Yes, inflation peaked at a painful 9% in 2022, but it's cooled significantly to just under 3%. Now, I've said this before. Just because it's gone from 9 to 3 does not mean that goods are getting cheaper. It just means that they're getting more expensive at a slower pace. But here's the truth. How quickly we'll actually hit the Federal Reserve's ultimate 2% target, it's still uncertain. And that uncertainty creates the caution. So that's number 1. Number 2, the Federal Reserve policy moves. We also don't know exactly when or how much the Fed will cut interest rates. And to be honest, the Fed itself has shifted its stance multiple times, initially signaling big cuts and then scaling back those expectations. Decisions about interest rates depend heavily on inflation, jobs, and economic growth, which means the short-term path, it remains murky. And it's that uncertainty that is contributing to the volatility that we're seeing in the market today. So that's number 2. Number 3, corporate earnings in the near term. Now, there's a ton of uncertainty whether earnings will meet optimistic 2025 forecasts, which is necessary to justify the historically high valuations we're seeing in certain areas of the markets right now. So ultimately, this means that stocks, they're expensive right now in some areas of the market. And really, the market is questioning whether or not they are worth their current prices. It's number 3. And then number 4, we all know this, geopolitical wildcards. You've got global conflicts, you've got trade disputes, and political instability are unpredictable. We don't know if the true effect of the Trump tariffs, what they're even going to be just yet. The details, they seem to shift daily. Rates change, new agreements are reached, and concessions are debated regularly. This may be what's getting all the press, but this is leading to a lot of emotional decision-making in the markets, which is what we're seeing reflected in the stock market over the course of the last couple of months. Recently, this has driven what we call the volatility index, the VIX, which maybe you've heard about, and that's oftenly called the fear gauge, which we have seen be significantly higher. Interestingly, many of the factors creating short-term caution, they're exactly what give us the optimism when we step back and look at the bigger picture. So when we widen our perspective and we focus on the facts, we see clear reasons to remain positive about the long-term direction of the markets. So we talked about what we don't know. Now, for each of those points, I'm going to talk about what we do know. And we're going to talk about why we are optimistic for each of those things. So let's go back to our number 1 point that we were talking, which was inflation. And the inflation trend. Well, it's improvement from the highs. Let's talk about inflation and the progress that we've seen over the course of this last couple of years. Remember, inflation has come down significantly from its peak of around 9%, as I said, in 2022, to nearly 3% as we enter 2025, based on headline CPI numbers. That's a major improvement, but we all know it's still above the Federal Reserve's 2% target. And here's what we know for certain. The Fed's goals are clearly lined out by their dual mandate: to maximize employment and to maintain stable prices. And they will not ease up on their fight against inflation until they're confident it's under control. So in February's inflation report that we got just a few weeks ago, we actually saw a bit of a surprise. CPI came in at 2.8%. That was lower than expectations. And this was a welcome sign. And on March 12th, amid recent market volatility, this report helped give markets some relief. Now, it was a signal that inflation is continuing to decline in a measurable way, which is an encouraging sign for both policymakers and investors. That's the optimism. All right, what about our second point? What's the Federal Reserve stance, right? The Fed has paused rate hikes after raising rates to above 5% in 2023. Actually, just today, they announced that they're going to hold rates steady until the next meeting, which was as expected and much like what we had discussed in previous Let's Talk Markets. But here's what we know as fact. We are now in a rate cutting cycle. Rates will be lower than where they are currently according to the Fed. And you can see this clearly in this chart, which shows progressions from members of the Federal Open Market Committee, each dot representing their expectation of where rates will land by year's end. So notice that while there's some debate among members, some leaning hawkish, which means higher rates, and others dovish, which mean lower rates, the consensus trend shown by this light blue line is strongly downward over the next 18 to 24 months. So why does this matter? Well, there's an old market adage: don't fight the Fed. Typically, when rates are down, borrowing costs decrease, allowing companies to invest more efficiently and cheaply into future growth. And historically, these rate-cutting cycles, they tend to boost markets, leading to stronger overall economic growth and better investment returns. So that's what we know. Now let's talk about our next point, number 3, markets weathering geopolitical shocks, right? We talked a little bit about that previously. Well, what we know is markets historically, they rebound after volatility driven by geopolitical events in particular. So let's put this in perspective by looking at this next chart, which shows the growth of a $10,000 investment in the S&P 500 from 1970 through 2024. Over this period, despite numerous geopolitical events, crises, and shocks, $10,000 would have grown, are you ready for this, to nearly $3 million. I think this visual is a powerful reminder that although events like these create short-term market volatility, staying invested through the turbulence has historically paid off, underscoring the resilience of long-term diversified investing. It's amazing when you look at that chart and you see how many geopolitical events we've seen since even just since 1970. My gosh, it feels like the world has ended 35 times over the course of that period. All right, now on to number 4, our final point. This one's probably my favorite, but it's volatility is normal. It's about the long-term perspective. The S&P 500 has averaged a double-digit intra-year decline since 1980, every year, on average. So let's take a look at this chart, which shows how much the market dropped during each year compared to where it ended up by December 31st. So it's a lot of colors, a lot of numbers. But the DD column that we see, it's what we call the maximum drawdowns. Those are the largest temporary declines experienced during those years. As you can see, every single year has experienced volatility. But notice how many years still ended positively despite these significant dips. And that's the TR, the total return column that you see. This helps us understand that volatility is a normal part of investing, even in good years. Like Ryan said earlier, there's no upside without occasional downside, no reward without risk. All right, so what's the bottom line here? Volatility in 2025 shouldn't come as a shock. I know we've talked about it here on Let's Talk Markets to expect it. But after 2 solid years in 2023 and 2024, we really knew this year was going to bring some turbulence. Now, while we're cautious in the short term, we are absolutely bullish on the markets long term. And we have good reasons for it, which we just outlined. Times like these remind us of the importance of stepping back, ignoring the reactionary moves triggered by daily headlines, and most importantly, having a solid plan in place. At Beavers Wealth Management, we don't just talk about plans. We proactively implement them every single day. Our job is to anticipate, not react, continually evaluating risks and opportunities to ensure you're positioned to not only navigate this volatility, but capitalize on it. Ultimately, we're here to give you confidence, clarity, and peace of mind, knowing that no stone is left unturned when it comes to your financial future. As we've seen recently, market volatility can create significant uncertainty. And the people you care about, they may be feeling unsettled about their financial future. And so, as I've said before in the past, if you have a friend or family member, or even a colleague who could benefit from a trusted second set of eyes on their investments, now is really the perfect time to introduce them to our second opinion service. I know I've mentioned this before, but we created this service so that anyone can come to us with their current investments, their financial plan, or even their strategy, and just gain a fresh perspective, ensuring their investments align with their unique goals, and then provide the reassurance they're on the right track. If someone you know could benefit from this clarity, we'd encourage you to reach out to us anytime, and we would be honored to help. All right, we covered a lot today, right? But I just wanted you to know that we're so grateful that you joined us, and we encourage you to share this content with anyone you might find valuable. We have the replays of all of our Let's Talk Markets now posted on our new YouTube page, and the video podcast is actually on Spotify as well. And so YouTube and Spotify, they're also home to our episodes of our new podcast. It's called Between the Bears and the Bulls. We've actually released a few new episodes this year, so make sure to check them out. They're a lot of fun, and it's a different perspective than what we do here on Let's Talk Markets. Honestly, too, if you have any suggestions on what you'd like to see from us, please let us know, because we want to make sure that the content we put out there is valuable for you. All right, now, one last thing before you go, because we've talked a lot about inflation lately, whether it's eggs or groceries or even housing. But personally, I wasn't too surprised when balloon prices went up. There's always inflation in that business, you know. All right, well, we'll see you next month for April's edition of Let's Talk Markets. And don't forget, leave it to Beavers.